Welcome back to the deep dive where we, cut through the earnings noise and get you up to speed fast. Today, we're jumping straight into ICICI Lombard General Insurance. Specifically, their Q2 and H1 FY26 results call from October 14th.
Yeah, this was interesting because ICICI, they've been walking this tightrope for a while now. The big question hanging over them was, can you really prioritize profit and, capital strength when everyone else is just chasing volume? So our mission today is to unpack whether their sort of disciplined strategy is finally clicking, especially with these big regulatory changes coming down the pike.
Okay, let's kick off with the headlines then. The Street was looking for about, $7.73 billion in profit?
That's right. And they delivered $8.2 billion in profit after tax, PTET. So a solid 18% jump year over year, definitely a clear beat. And importantly, this wasn't at the expense of their capital base. That looks really strong.
Right, strong capital. Let's talk metrics. Return on average equity, ROAE. That tells us how well they're using shareholder money.
Yeah, and for the quarter, that ROAE was 21.4%, which is, pretty good number in this sector. And the other key one, their solvency ratio, basically their safety buffer came in at 2.73 times.
2.73x. And the minimum required is only 1.5x, right?
Exactly. So they've got this huge cushion, almost double what's needed. Right. Really robust.
Okay, so strong profits, massive capital buffer. Sounds like that gave them confidence on the dividend front, too.
It certainly looks that way.
Yeah.
They bumped up the interim dividend to 6.5 per share. That's up from 5.5 last time around for the half year.
So a pretty positive picture on the surface, but I remember the market's been a bit nervous about their growth, specifically the premium income.
That's exactly right. That's the complexity here and where the anxiety was. Total income grew, 12.5% year over year. Decent.
Oh.
But the key number everyone watches, gross direct premium income, GDPI, just the raw sales volume actually fell by 1.9% in the quarter.
Okay, a drop in GDPI. That does sound like a red flag, like they're losing ground.
It sounds like it, yeah. But management was very clear on the call. This was strategic. It was deliberate. They're actively choosing not to chase business in really low margin areas. Think crop insurance, certain mass health schemes where, frankly, the profitability just isn't there.
So they're filtering out the unprofitable stuff. If you strip that out, what did the growth look like in the segments they actually want to be in?
Right. Excluding crop and mass health, their GDPI actually grew by 3.5%. So it shows that focus, profit quality over just headline growth numbers.
Okay, 3.5%. But hang on, the overall industry, excluding crop, grew at nearly 10%, right? 9.8%.
That's a number.
So even in their preferred segments, they're still lagging the market quite a bit. Isn't that a long-term risk? Sacrificing share now?
That is the core tension, absolutely. And it forces you to look really closely at their underwriting. Is the quality offsetting the lower volume growth? That's their whole play.
Okay, so let's look at underwriting then. The combined ratio losses plus expenses as a percentage of premium. That ticked up a bit, didn't it? To 105.1%.
It did, yeah, up slightly from 104.5% last year. But, and this is crucial, there's a specific reason for that uptick. It was almost entirely driven by catastrophe losses, CAT losses.
Yeah.
Big weather events, things like that. Those came in at $0.73 billion.
Right, so one-off hits. If you normalize for those, what does the core underwriting performance look like?
If you strip out the CAT losses, the core combined ratio was 103.8%. Now, that's slightly up from 102.6% last year, but it's still very much within their historical range. It shows the underlying business, the day-to-day underwriting, is holding steady. They're managing costs and risks controllably.
Okay, so underwriting is stable, maybe even solid ex-cats, but they deliberately slowed down volume growth. So where did that big 18% profit beat actually come from then?
Good question. The answer lies heavily in their investment portfolio. That provided a really significant tailwind. Over the first half of the year, their profit before tax jumped 22.3% to over $20 billion. And a big chunk of that, $6.16 billion in H1, came from capital gains on their investments, net of any impairments. So the investment side is really helping to smooth things out and boost the bottom line.
Got it. So investments are buffering the deliberate slowdown in certain premium lines. Let's pivot to the strategic side, because it sounded like management sees things potentially changing quite dramatically.
Yeah, they painted a very optimistic picture looking forward. They're basically betting that their discipline holds just as the market gets a major boost. They pointed to India's strong GDP growth, 7.8% in Q2, still robust. That fuels everything. And of course, the recent S&P sovereign credit rating upgrade that helps sentiment, attracts investment.
Okay, positive macro backdrop. But the really big news seemed to be around regulation, specifically GST changes, like potential game changers for volume.
Absolutely. This is where they see the opportunity to get back to stronger growth, but importantly, profitable growth in the segments where they excel. The GST reforms could be huge.
Okay, break those down for us. What's the first big one? I think it was related to health insurance.
Yes, the headline changes the exemption of GST on individual health insurance premiums. Think about that. Health insurance just got cheaper overnight for potentially millions of people. The expectation is this will be a massive boost to demand, getting more people covered.
Wow. Okay. Removing a tax on an essential, like health insurance, that feels like a powerful nudge.
Yeah.
What about the motor insurance side?
The second reform is rationalizing GST rates in the auto sector itself, lowering the tax burden on cars. Management thinks this will spur vehicle sales, upgrades, basically more cars on the road needing insurance. And crucially, they committed publicly to passing the entire GST benefit onto customers, reinforcing that customer-centric angle.
And that customer focus, combined with good service, seems to be working already, particularly in retail health. That segment looked really strong in H1.
It really did. Grew 25.2% in the first half. That absolutely smashed the industry's retail health growth of about 9.3%, even with some accounting changes muddying the waters a bit. They even hit a record market share, over 4% in September.
And you mentioned service driving that.
Definitely. Look at their claim stacks. Retail health claims settled within 30 days, 99.6%.
99.6%. That's incredible. How does that compare?
Well, for context, the industry average for settling motor-owned damage claims is around 82.4%. So ICICI is leagues ahead in health claims efficiency. They put it down to investments in AI, digital processes. It gives them a net promoter score of 72 for health claims. That kind of service builds loyalty, especially when the GST changes make the product more attractive anyway.
Okay, let's switch to motor. H1 growth there was much weaker, just 2.2%. You mentioned tough competition, pricing pressure.
Exactly. The whole industry is struggling with profitability in motor. The industry combined ratio is up at 125%.
Ouch. Losing 25 pays on every rupee of premium.
Pretty much. So ICICI chose discipline. They held back a bit in H1 rather than chase unprofitable motor business.
Yeah.
But they signaled things might be turning.
Right. They mentioned a pickup in September.
Yeah, a sharp uptick in volume in September, carrying into the Navratri festival period. Private car sales apparently jumped almost 35% during that initial festival window. That gave them confidence for a much stronger second half, especially with the GST tailwind helping auto sales. Their plan is still to lead the market. They had 10.4% share in H1, but to focus that leadership on the more profitable bits, like private cars and two-wheelers.
So looking ahead, the message was, stick to the plan, keep aiming for that 20% plus ROE, leverage digital, improve the mix, and expect better growth in H2 as CIT losses fade and these GST tailwinds kick in.
That's the essence of it, yeah. The core story is discipline through the tough times has preserved their capital strength, and now they're positioned to catch this wave of regulatory-driven volume, hopefully without sacrificing margins.
Which must be a relief for investors, given the stock's performance over the last year was pretty poor, down about 11% when the Nifty 50 was down maybe 3%.
Exactly. It underperformed significantly. So this earnings print, the strong ROAE, the dividend hike, it provides a bit of a fundamental floor, maybe reassures the market that the strategy is sound.
So what should investors be watching for now? Key risks or follow-ups?
Two main things, I'd say. First, does the volume actually materialize in Q3 and Q4 from these GST changes? We need to see the proof in the numbers. Second, keep an eye on claims inflation generally and any signals from the regulator, IRDAI. Specifically, any talk about adjusting the motor third-party tariffs, the regulated prices for compulsory TP insurance.
Right, because if those regulated TP prices go up, that would directly help motor profitability across the board. Management must be hoping for that.
Oh, absolutely. That's definitely on their wish list. Okay, shall we shift gears? Time for the more speculative part of our deep dive, the This Is Not Financial Advice segment.
Let's do it. And yeah, heavy emphasis on not financial advice. We're just connecting dots from the call, playing with ideas.
Okay, here's the pitch. It's a pair trade designed to play that theme of superior discipline meeting regulatory tailwinds.
Intriguing. What's the trade?
The idea is go long ICICI Lombard and simultaneously go short the Nifty 50 General Insurance Index, or, some ETF or basket that tracks the average competitor.
Okay, long ICICI Lombard, short the competition. Why the short leg? Why not just be bullish on ICICI Lombard?
Because the rationale hinges on the difference in quality and positioning. The market, arguably, has priced ICICI based on its recent slower growth, a result of its discipline. But now these GST reforms are set to unleash volume, especially in retail health and motor, precisely where ICICI boasts superior efficiency. Remember that 99.6% health claim settlement?
Right. They handled a profitable business better, protecting their margins.
Exactly. So the thinking is ICICI captures this volume surge profitably. Their less disciplined competitors, who made up the index, will also see volume, sure, but they risk getting hammered by claims because their underlying combined ratios are already weak, like the 125% in motor for the industry. So this pair trade tries to capture that spread, betting that the disciplined leader outperforms the average player significantly as this new volume flows through. You're betting on the margin differential.
That's a sharp take. Isolating the operational advantage against the industry backdrop. Okay, let's recap this deep dive then. We saw ICICI Lombard deliver a strong profit beat, maintain high ROAE, raise the dividend, all while signaling clear strategic intent. Maintain discipline, but get ready to capitalize on potentially huge H2 volume from GST reforms.
Yep. And that leads us to our final provocative thought for you, the listener, to mull over. Given their relentless focus on that 20% plus ROE target and their proven best-in-class claims efficiency, is the market still underestimating ICICI Lombard? Is it undervaluing the compounding power of disciplined profit growth, just as these big regulatory tailwinds finally arrive?
Something to consider as you do your own homework. Thanks for joining us on this deep dive into ICICI Lombard. We'll catch you on the next one.